So welcome everyone to the FBT and GST seminar. I would like to begin by acknowledging the traditional owners of the land on which we are meeting today. I pay my respect to their elders past, present and emerging, and the Aboriginal and elders of the other communities who may be here with us today. For those who don't know me, my name is Rupali Vama. I'm manager of financial assurance and accounting team that sits under the financial and property services branch. And I've got here with myself, Glenn Kong. Some of you would already know him. Glenn is the senior technical accountant in the department, and he's the guru of GST in the department, and he also does FBT. So if you've got any GST or FBT related issues, Glenn is your man to go to. I'm just trying to tell everybody, don't come to me, just go to Glenn. Sorry. Now, as you guys know, each year we've got, we do this FBT and GST seminar. The whole purpose of this seminar is to update the departmental and agency staff on the key updates for the current year that the ATO brings forward for FBT, and also to sort of take us through what FBT and GST entails. Now, like last year, this year's session will also be conducted by Shine Wing, as you can see them on the screen. So without further delay, I would like to introduce Stephen Flynn. He's the partner from Shine Wing, Rahul Sangani, who's the senior manager, and Rob Parker, who's consulting director. So I'm just going to hand over, Stephen, to you now for you to take it further. Thank you.
Thanks a lot, Rupali. Thanks for the opportunity to present to the Department Jobs, Precincts and Regions today. Most people are pretty used to running with seminars over Zoom these days, but this one's being run as a webinar. Therefore, we sort of can't see participants. If you have any questions, there's a Q&A function at the bottom of the screen. Please feel free to use that throughout the presentation. We will be monitoring that, and we'll be answering those questions throughout the session as the questions get raised, or if we feel that they need to be left till a bit later, we might take them at the end. So we probably don't have enough content to get through the full hour and a half, so we are expecting to get a few questions and help people throughout the session. So what are we talking about today? Well, we're going to be breaking up into sort of three parts today. I'll be running through the basics of FBT, focusing on probably one of the major benefits, being entertainment, cars and car parking, and really having a bit of an impact of what the some of the COVID-related concessions the government have made, and how to probably think about things in a COVID environment, because it is quite different to prior years. Obviously, we're probably thinking that the FBT liability should drop this year because there probably hasn't been as many benefits provided. We'll cover off on a few, Rahul will then cover off on some of the less common benefits, but equally you need to be aware of them because they might apply it in your situation. And then we'll run through a few other recent developments. And finally, concluding things, Rob's going to do a bit of a refresher on the GST rules. There hasn't been a lot that's changed in respect of GST, but it's important that people are aware of the requirements for GST.
Stephen, I'll just like to add that for the department, Glenn does the FBT. So Glenn does the calculations and the gathering of the data and everything, and the agencies do their own FBT. So just wanted to add. So for departmental staff that are here, it's Glenn will be running the FBT for the department, but he will be reaching out to the various areas to collect the information and data.
Okay, thanks a lot, Rupali. So we'll just start out with a couple of the basics. And just so people know that FBT is a tax that's levied on non-cash benefits. It was trying to make sure that people were not transferring things which are salary and wages to a benefit, and So equally, the after-tax outcome for a person on the top marginal tax rate is the same whether you get salary and wages or a benefit. So there's a couple of key elements that exist in the fringe benefits tax regime. Firstly, there must be an employer who provides a benefit to an employee. And the provision of the benefit must be in respect of employment. FBT is an employer tax, and the ultimate liability rests with the employer. So we'll be covering off some of these concepts a bit further later on. But you also need to be aware the FBT year is not the same as the normal financial year, and it's actually 31 March. Obviously, we're now in April, so people should be preparing their 31 March 2021 FBT returns, and the FBT rate is 47%. Okay, so firstly, just some of the basics. Sorry, my light in my room's gone out. I'll keep going. The benefits that arise relate to goods and services, so it can cover off on cars, interest-free loans, various different things. So it's any benefit. It can also cover rights to acquire various things. So it's a very broad concept of what is a benefit. For FBT to arise, the benefit can be provided by the employer, or it also could be somebody else who's arranged the benefit to be provided. An easy example, we used to do some work for Holden. They're a manufacturer, but they provided benefits to sales staff at the auto dealership. So the auto dealer was the actual employer, but the benefit was being provided by Holden under an arrangement. So therefore, even though it isn't the employer providing the benefit, it's actually an associate. Because there's an arrangement involved, the employer was required to pay the fringe benefits tax liability. Might sound a little bit unfair. So generally in that situation, someone like Holden would have subsidized the FBT liability and given that additional cash over the auto dealers as well. Otherwise, auto dealers wouldn't have allowed them to do that. So you just need to identify who is the employer. It's only ever the employer who's subject to FBT. Also, fringe benefits.
Stephen, I've got someone saying, can captions please be turned on in the FBT GST seminar? So can we turn on the captions?
Lucy, can you do that? I'll see if she can get that sorted.
Thank you. And so, Stephen, in government space, what you've just said with an example of Holden, so in government space, would that mean that if some other department is providing benefit to our staff, then would we be recording it?
That's correct. So it depends which, like if the department's providing something to an agency, it depends where the employee sits. So sometimes it can be hard to identify that, but if a different department is the one that's providing the benefit, it's actually still the employer who has to put in its FBT return. So that particular department or agency where the employee is employed.
Oh, okay. Thank you. Not sure if we could get the captions on. I'm not sure.
I'm not sure. I'll get Lucy's there, so hopefully she can get that working.
Yeah, Audrey is saying it's not working. Oh, she's saying that she has never worked on captions before, so she's working. So Audrey, we are on to it. We'll let you know.
Yeah.
And we've got a question as well. Oh, Rahul is answering. Rahul is on it.
Okay, one other question we do get, obviously if benefits are provided to spouses, they're also going to be subject to FBT. So if a spouse comes to an event with the staff member, that will also be captured. Another question we do get asked is whether benefits provided to individuals that are engaged through labour hire organisations are also going to be subject to FBT. Generally in these situations, the person is, if they're engaged through a labour hire organisation, it's really the labour hire organisation who should be subject to FBT. So if the department's brought people in and they've provided them a benefit, potentially they need to advise the labour hire agency of the benefit. Just quickly, here's a bit of a framework that shows all of the different fringe benefits categories. So the way FBT works is you have to find the most specific benefit category, and that's the one that's subject to FBT. If you don't find any particular category that applies, they're likely to fall into the residual benefit category, which is a catch-all, which uses market valuations. Rahul, if there's any answers you want to answer live, just feel free to jump in as opposed to going through the Q&A.
Sure, Stephen.
Okay, so with the basics around calculating the FBT liability, you firstly need to determine the taxable value of the benefit, and each benefit has a different calculation methodology. It's generally the cost of the benefit or the market value. Then you need to apply the appropriate gross up rate, and the gross up rate will depend upon whether it's something that you're able to claim a GST input tax credit or not. If you are able to claim a GST credit, then it's a type 1, which is a gross up rate of 2.0802, or if there's not able to claim a GST credit, then it's a type 2 gross up rate, which is 1.8868. The other thing to look out for is that reportable fringe benefits amount. Now, this should all be automated through your software, can be a different number, because that's always going to be based on the type 2 gross up rate. It never uses the type 1 gross up rate. So there can be a difference between what goes in an employee's reportable benefits summary and what goes into the FBT return due to that. So just some other parts of the basics. There's a few specific exemptions or concessions that apply. The main one that's available is the minor and infrequent benefits exemption. Unfortunately, this doesn't apply for tax exempt body entertainment. So whilst a lot of other people who are not in, and the department is a government body that's tax exempt, so therefore it can't access the minor and frequent benefits for tax exempt body entertainment. However, it can use it for other benefits. So if there's, say, a minor use of a car park or a minor use of a car, those sorts of things potentially may not be subject to FBT due to the minor and frequent exemption. Just quickly, what's the minor and frequent benefit exemption? That applies where there's a couple of criteria. The first one is that there's a notional benefit of less than $300. So it has to be for an individual benefit under $300. And it has to be provided infrequently and irregularly. So we do get questions asked, what does infrequent and irregular mean? Unfortunately, there's no hard and fast rule, and we can't say it's based upon the number of times you do it. Having said that, we do generally think that, look, if you're doing something more than 12 times a year and it's worth more than $100 each time, I think that would be something that's probably starting to get on the more frequent scale. If it's only a few times a year for 3 or 4 or 5 times a year, it's for $100, we think that's not all that frequent. So you do have to do it on a case-by-case basis, but unfortunately there's no hard and fast rule and requires judgment.
Stephen, the other thing is you've got the $300 there, and I think one of the most common questions that we get on that is it 300 in total, 300 per transaction? How do we evaluate that?
Yeah, so the 300 is a per transaction basis. So you could have, just say, for example, someone has a car that's a pool car that's available, even though you're not meant to be using it for this purpose. If someone took it home, for example, for work purposes, but then used it for a personal purpose that's for under $300, then potentially, if you only used it once, that would be minor and frequent. And you've counted through. If you then use it, say it's worth $250, and then you've used it another 2 times for $250, it's still only 3 times. It's only $250. That's $750. That's probably still okay. Not that you probably aren't able to do that under your policy to use it for private purposes, but that's an example of where it's per incident of $300.
However, just to add there, I mean, there is a rule, integrity rule in those provisions which say it has to look at the associated benefits as well. So you cannot purposely go out of your way to break down a benefit which is costing, say, $500 into a two transaction, 300 and 200. So it looks at associated benefits along with the main benefit as well.
Thank you. Yeah, so obviously the main time you can't use that is for the tax-exempt body entertainment. Unfortunately, you also can't use it for in-house expense benefits or if people are using the 50/50 for entertainment. The other major exemption or reduction that's available is the otherwise deductible rule. So this is basically saying if the employee had have been claimed the expenditure or incurred the expenditure in their own name, would they have got a deduction for it? And if that's the case, then the otherwise deductible rule applies to reduce the taxable value down to 0. So the sorts of things that could be in there is if you, for books or something for work, or some sort of program you need for work, or some sort of training that's work related.
So I think we use this for the CPA and this
Official memberships.
Official memberships. So if you want to expand, because what we do is in our system, we've got an inbuilt thing that says, is this 100% deductible, for them to say yes. So, you know, it's a good thing to say here that that's the reason why we've got that, so that we can reduce the FBT.
Okay. So just going to entertainment a bit more detail. I have seen a few questions being answered by Rahul as we've gone through the Q&A, so thanks, keep them coming through. So entertainment, firstly, whilst there is tax-exempt body entertainment for tax-exempt bodies, generally there is no entertainment category other than that one. So, but what, I suppose understanding what is entertainment, the definition of it is a provision of entertainment by way of food or drink or recreation, and includes accommodation or travel in connection with or to facilitate the provision of such entertainment. So one thing to look out for here is not all food and drink is entertainment. But if there is food and drink involved, then you need to consider whether or not there's entertainment. So what we'd say today, look, can't really give the example because we're having a virtual session, but normally we do have a break and we provide some sustenance for people to get through the session. So that type of thing would not be considered to be, that would just be tea, coffee, that type of thing, just sort of to refresh people. So, so that would not be considered to be entertainment of itself. So, but entertainment can take the form of a full course dinner. That's sort of the meal entertainment. In some situations, entertainment could be tickets to sporting events, tickets to the tennis, property benefits if you give someone a Christmas hamper, or if you provide accommodation or transport, it could be a residual benefit sometimes. Now, when trying to determine whether or not something is entertainment, if it's food or drink, you've got to ask yourself the 4 W's. Why is the food being provided? What type of food or drink is being provided? When is the food or drink being provided? And where is the food and drink being provided? So if the food, why is the food or drink being provided? If it's to celebrate something, or it's to reward people, it's likely to be entertainment. Obviously, if it's being provided for sustenance purposes, because people are working through and providing some food to get them through the day, then that's not going to be entertainment. What type of food or drink is being provided? That's where we say, like, if it's a 3-course meal, it's more likely to be entertainment than just a coffee, because a coffee obviously is quite more in the nature of sustenance. When is it being provided? If it's in a restaurant setting, that's going to be more likely to be the case. If it's providing in the office environment, it's not going to be the case. And when is it being provided? Obviously after hours, after work, it's more likely to be subject to be entertainment. So we sort of mentioned before, just the definition of entertainment, just to clarify, sustenance. As we've said, tea, coffees, biscuits, sandwiches are not general. Similarly, if it's a light meal under $15, the general feeling is there that you don't get much $15 these days. Probably a sandwich and a drink would be about all you get, so if you're lucky. So therefore, you're generally not going to be providing entertainment. Meals whilst traveling. If you're traveling for work, you are able to get travel allowances for food and drink because you're entitled to have some sustenance whilst you're traveling. And the other big one that probably covers a lot of food and drink might be if you're doing a CPD course. So if it's a course that's more than 4 hours, then it's going to be a CPD, and it qualifies as a CPD course, then there can be food and drink provided with those courses. Now, there is a decision tree that's available on.
So, Stephen, before we go to the decision tree, I think for us in our department, we've got that issue where when we are traveling, we might be going for, while we are traveling, then there is a dinner where we've got some hosts and then we've got some staff, internal staff. Then, you know, that's when the staff kind of have got a bit of concern of how to sort it out in what bit will be travel and what bit will fall under entertainment.
Yeah, so if they're traveling, you are entitled to a meal whilst traveling, but generally that's expected that you're either having that meal with people from your work or you're having it by yourself. Like if all of a sudden it's lavish 3-course meal and you're doing it with people who are hosting and it's all on the one bill, then it's probably likely to be more in the nature of entertainment. But it is a grey area that you need to look at, and it does depend how it's documented.
So the way I've kind of communicated it to staff that have raised this question is that for your element of the bill, that's not entertainment, but if the other staff who live there and are having a meal with you with alcohol and everything, which is a bit lavish, then the element of theirs would be entertainment. So is that correct, or am I wrong in saying that? Is there still a gray area?
That is a reasonable approach to take, Rupali, because any staff who's traveling overnight on business, his meal costs would be considered otherwise deductible.
Yep.
And people who are not traveling, and if they are going to that dinner or that event and their meals is more than sustenance, then the expectation would be FBT would be payable.
Okay, thank you.
Yeah, the question of alcohol, I think generally, I'm not sure what the rule is in the department. Generally, government doesn't like people having alcohol. I don't know, do you allow people to have alcohol or not?
Yes, we have. So what we've said is we've gone with the ATO ruling that says
Okay.
a glass or 2 is fine with a meal. So
Yep.
we've adopted that as our approach.
Yeah, okay. Yep, and that is the ATO approach. If it's they do think you can have a beer or a glass of wine with your alcohol. You wouldn't want to be having a couple of bottles, but yeah, one glass or 2 is something that's acceptable to still be sustenance. Yeah.
Yeah, and the department feels that because a lot of places in regional, people might go to a pub where, you know, it's like $17 for a meal and a glass of wine. So I think in that sort of scenarios, we find that to be reasonable.
Yep. Yep. Yes. So there is a decision tree. Now, I'm probably not good at, I can get up off my screen, but I don't know how to switch it across very well. So Glenn, did you want to explain just the decision tree or where to find it within the department?
Is that the one that I need to look at what you're intending to show?
Yeah, sorry, I wasn't going to show it. Let me see if I can.
I believe this is, Rahul, is this what we provided last year as well?
Actually, I'll bring it up. Here we go. Here it is.
So correct. That is the decision tree.
All right. So that's available in our intranet. So if you there are certain scenarios to guide you in making that decision, whether it's FBT-able or otherwise. There's some explanatory notes underneath. It is pretty self-explanatory, to be honest, and it's available on the intranet. If there's any clarification that you require, by all means, give me a buzz and we can talk through the details.
No worries. Yeah, thanks. Thanks,
And
Glenn.
the decision tree also has account codes in it. So what it does is it takes you through whether something will be travel or whether something will be entertainment and hospitality. So it kind of does that.
And because we have implemented a new Oracle Cloud, so some of the accounts codes would have changed. And we have actually a list of the changes.
Yeah, so I've got a list on the screen now. So I'm not as familiar with the account codes and what should go where, but they are included in the pack. I think someone's asked, will the pack be provided? Yes, we will provide the packs. There is a list of all the codes. Are these the up-to-date ones now?
Yes.
Correct. That's right.
Yeah. So, so if people don't know where to find the Excel the flow chart, feel free to reach out to Glenn to get that. So are there any particular codes we need to mention, Glenn, that for attendees?
Sorry, I missed you, Stephen.
So I'm just wondering, I'm just flicking through the screen. It's in the pack. I wasn't intending to go through in detail, but are there any particular codes that are new that people should be aware of when inputting the entertainment?
There's a list of travel and related account codes that are probably most relevant to the staff, I would have thought. What I can do is perhaps when you send out this decision tree, I'll give you those accounts maybe by grouping.
Yeah.
For instance, if travel and related, they come into one group, and entertainment another, food and drink. Maybe that's going to help them in applying, in using the decision tree, and making a decision.
Okay, good. Yeah, so the main thing there is people just be aware there is a decision tree. There are some resources. When we send out our slides, there'll be a list of all the account codes you should be using to help you to work your way through that. So as the department is a tax exempt body, it does look after tax exempt body entertainment. So it is important you do get the classifications correct, that whether it is entertainment or not, because what one of the options under the tax exempt body entertainment, there's a 50-50 split method. So anything in those accounts will get analysed, but equally 50% will be treated as subject to FBT and 50% would not be. The department does have the option to keep a 12-week register method to go through and determine whether or not entertainment is client entertainment, or to see what gives them the better result, or they could use an actual method. So I'm not sure what every year it can be assessed differently. So I don't know what the decision will be this year, but it is important that people allocate things correctly so that the department can get the best outcome.
Well, historically, we have used the actual basis.
Yeah. And then obviously...
Sorry, just to add there, Glenn, historically, you've used the actual basis because you had the Hall of Fame event.
Correct.
Yes. Yeah, correct.
Yeah, so it's important people do continue to use the right account codes going forward. And as I said before, the minor and frequent benefit exemption doesn't apply for tax exempt body entertainment. Might pass that one. And I don't think we need to go into detail on these methods here, other than to say that that there's analysis undertaken probably at the corporate level. If you're an agency and you're doing your own FBT return, you might want to look through the actuals. Pretty self-explanatory, comes through account codes. 50-50 is just a 50-50 split, but the 12-week register method does require you to do analysis over a 12-week period. But because you're using the actual method, we wouldn't be expecting people to use a 12-week register. But if you want to, that is a shortcut method. So instead of getting a whole year's worth of data, you can just use an indicative 12-week period. Whether that's possible in a COVID period is a bit difficult to say, because obviously with lockdowns and those types of things, how do you determine what is a relevant 12-week period? There's particular rules for entertainment facility leasing. So I'm not sure whether any of the government departments have any corporate boxes, but a corporate box would be considered a entertainment facility leasing expense. Equally, if you're hiring out a marquee or say a boat or some sort of venue and you're paying a venue hire, that can be treated separately to the other entertainment benefits. So it doesn't have to follow the same approach. It can be split out and you could use 50-50 for that, or you could use an actual method for allocating the value of the entertainment facility leasing. Now, obviously, the entertainment, it doesn't normally get included in the employees' payment summary, but there has been some updates in the system to capture the expenses and attendees. So the actual method is being used by the department. That's probably an old slide. It's probably been there for a while since Oracle's been brought in. Okay, were there any other questions on entertainment we needed to clear off?
No.
Okay, thanks. Okay, so car fringe benefits. This has always been the major benefit in most organisations. So it's important to get it right. There are a number of tricks and traps where you can reduce the value of the car fringe benefit. So first of all, there must be a car. The car must be held by the employer, and the car is either used for private use purposes by the employee or an associate. There's a deemed private use percentage, and you also have to be, even if you're in control of the car, so if you've got the car keys, even if the car is at your house, you're not driving it, or you've gone away for a holiday, you still can be in control of the car. So it's important that if you're going away and not going to be using the car, you should park it at the department's or one of the agency's premises. So what is a car? A car is a vehicle such as sedan, station wagon, that's designed to carry a load of less than 1 tonne or fewer than 9 passengers. And it excludes vehicles that are not designed to carry passengers, such as single cab vehicles. Where a vehicle does not fall within the definition of a car, it doesn't mean that it's not subject to FBT. It just means it's not a car fringe benefit, and therefore it might be subject to the residual fringe benefit. If it's a residual fringe benefit, there are different rules that apply. Okay, now historically, most of our clients find that the statutory formula method by far and away provides the best outcome for most cars, unless the cars are being used on the road and you're a salesperson or you have a job which requires you to be on the road a fair bit. In which case you might look at the operating cost method, because the operating cost method looks at your actual business use percentage and gives you a bit of a discount in that. So we won't go through a lot of detail today because on this, but obviously the operating cost method is something that should be looked at a bit more due to COVID, because obviously people might not have been using the cars as much, and that might become an option going forward. So with the statutory formula method, it's a reasonably straightforward calculation. You look at the original cost price that's been paid for the car. You add any costs of any fitted non-business accessories, any special wheels or anything like that. And you look at the dealer delivery charges. Important thing to look out for, it does not include registration or stamp duty. So the number of days that the car is available for private use is one of the issues that you need to look at. You'd need to return the car and not have access to the car. So if in COVID you said, okay, we don't have the car, we've taken it back to work, we don't have the keys, then it's not available for private use, and you can get a bit of a reduction for that. And you multiply the number of private use days over the number of days in the FBT year, and then you can reduce the taxable value of the car by any employee contribution. So, so that's the statutory formula method. With the operating cost method, you have to look at all the operating costs for the car, there's a deemed calculation for depreciation, interest charge. Now there's also a percentage of private use. So this is where in the COVID environment, we'll come to this later on, but you can get a reduction because a lot of people weren't using their cars in COVID. And even if you had your car at home and was in lockdown, if you can demonstrate that it wasn't being used, the tax office has said we'll take a concessional approach in the operating cost method for the private use percentage if you didn't use your car. So I'm not sure whether the department, like some hospitals, that type of thing, obviously in COVID there was no drop off in that area, but in some other organisations, if you're in the finance area and you never had to go into the office and you're in lockdown, your car never left and you kept a record of that, you can get a reduction in private use, but you will need a logbook to demonstrate that. And finally, actually, so you don't need a logbook, but you'll need to keep records of it. And finally, you can get a reduction from the employee contributions. So what are we talking about? When is the car held by the employee? Oh, sorry, it has to be a car that's provided by the employer. And so the employer owns the car or leases it under a novated lease arrangement, or otherwise makes the car available to the employee. Available for private use, where the car is not at the employer's premises overnight and is available for private use of the employee, regardless of whether they have permission to use it. If the car is garaged at the employer's home, it will be private use.
So Stephen, this is a question that gets raised a lot in the department because we've got our fleet cars and sometimes the fleet cars are taken by the employee's home because the next day they are traveling to a regional area or they are going for inspection in some area. So then the question arises is whether for that, the kilometers that they've traveled from work, say at 5 o'clock today in the evening to go home, and all that, that's private or business. That's always asked.
Yeah. So if it's the practical that to take it like they're where they're going is closer, say, to their home than where the work is, it's practical to take the car home to take it the next day, then that wouldn't be private, but you can only take it in a direct route. It is a bit grayer if, say, for example, the office is closer to where they need to go the next day and they pick it up, and if they're actually driving it home, and then it was easier to just for convenience. So that's a bit grayer, that situation, but generally we would think that home to work where they needed to take it because they needed to go somewhere the next day is generally okay.
Okay.
So examples of private use is home to work. That, as you highlighted there, home to work is almost always going to be considered to be private use. And if it's home to a secondary work location, so there could be a situation where it's a question of what's your primary work location. If it's going to a secondary work location, you have two of them, that could be a private use. And if you're on call and you've got a car but you're not called out, that also can be private use. So that's a bit unfortunate. Business use, the travel between the primary and secondary work locations. I think an easy one to explain this might be is if you've you've had to go, the department has two offices, one might be in Melbourne, one might be in the region. If you've gone in from your home and you've gone into the office in the city, and then you've had to go to the region, the travel between the city office and the region or place of work will be business. But if they had gone directly from their house to that secondary office, then that would have been private. And if it's
Stephen, this gets raised by a lot of our execs, so that's why I'm raising it here for the benefit of the staff, especially in agriculture space, where we've got our exec directors that might say, for example, have their primary place as Atwood, and then on that day they have to go from Atwood to the CBD for meetings. So in that case, the travel from Atwood to CBD is work related. And if in that instance, if they have their e-tags and the cost incurred by the e-tags will also be work related.
That's correct. Yep.
Yeah. Okay. Yeah. That's and the key here is primary work location now,
Yeah.
and the secondary work location. Some of the concerns that have come to us from again from agriculture space is how do you define primary and secondary? What sort of record or paperwork is needed to define primary and secondary?
Yeah, well, generally, when someone has an employment contract, the employment contract will specify where their place of employment is. So that's probably the first place the tax office would always have a look at. If that changes over time, because obviously you might have an employment contract and then the reality is you move around, they didn't do a new one, it probably should be an email, or there should be some evidence to say where their primary work location is. Now, if people don't have a primary one and they move around a lot, that can be a bit harder. But obviously, if there's two places, they probably have to choose one of them as the primary. You can't have two primary locations.
So it doesn't need to be formalized, and email an agreement with the manager or someone to say that should suffice.
It should be documented. When I say they do it, it should be documented. How you document it, there's no hard and fast rule, but you'd want at least the FBT person should be getting a copy of an email between a manager and the person, just saying here is where the primary location is. But as I said, the employment contract's the main one, and then if you don't have something that's clear, you will need something in writing that can be evidenced. Yeah.
Okay, thank you.
So the other one is where you might not have a regular work location. I'm not quite sure for DJPR, but like something like Vic Roads, where you have people who are always on the road traveling out to different parts of the road network because they're doing inspections on roads and that sort of stuff. They have an irregular work location. They do not have a primary work location. All of that travel is going to be work related for them, so they're in that position. Another one, if you're actually on call and you're called out, then any of that travel or any of that use of the car will be business related as well. Mentioned before, if you're using the operating cost method, you need to keep a logbook, and a logbook must be kept for a period of 12 weeks. So in the COVID period, if you're looking to say that you want to use the operating cost method, because the car was locked up at home and you've got evidence that that car wasn't used for 6 months. And like I know for myself, my wife and I, we both had a car reg, but my wife didn't go out much and we just used the one car. If you've got record of that, then you can say that that wasn't a private use day. But you do need to have a 12-week logbook in place to use operating cost methods. So it could have been taken out for a while, and you can have a logbook for 12 weeks that lasts for 5 years. So even if you had have started a logbook in March 2021 and you had have continued to do it over the next 2 months, which is the next FBT year, that can still count as an eligible logbook.
Sorry, Stephen. Given the COVID situation and the change in pattern of use, so a logbook from prior years presumably cannot be used for this FBT year because of that change.
Well, I think there's a concession that's been provided to say that that is your normal pattern of use. Now, the fact that there were certain days that you didn't use your car, because the logbook, if we go back to the formula, is percentage of private use minus employee contributions. So that percentage of private use, the concessions relate to a lot of the costs. So in the cost price calculation, they can reduce the cost of the car, because if you didn't hold it for a certain period, your total operating costs get reduced as well. So they've sort of talked about certain costs not being included. Rahul, did you have anything to add on that one?
Questions that was asked. Can you repeat the question again, Glenn?
Oh, I was just saying because you can use a logbook for up to 5 years.
Yeah.
During the COVID, the pandemic period,
Yeah.
the use obviously is not going to be the same as prior year.
Correct.
And therefore, on that basis, does that mean we have to keep new logbooks for the 2021 FBT year?
The ATO has come out with a concession, and they said as long as your logbook is valid for the 5th year, and this is your 5th year, you can make a reasonable estimate based on the odometer readings that you would have been maintaining. So what they've said is this year, because it's not representative of earlier years,
Yep.
you can make a reasonable estimate based on odometer readings at the start of the year. In between the year the car's gone for service, you can assess how many kilometers it has done.
If this is the 5th year.
If this is the 5th year.
Only if this is the 5th year.
Only if as long as the logbook is valid. So if this could be the 2nd, 3rd, 4th, or the 5th year.
Yeah.
We've got another question, Stephen, that might be a bit relevant to everybody. Is if during lockdown, if an employee decides to go to work to either pick up a piece of stationery or print something or pick up some work computer, is that travel from home to work considered business travel or private?
Yeah, look, it's a good, I haven't had that question before, so it's a good question. Generally, I would have thought it's traveling to work and it's going to be private in nature, as has always been the case.
I would have thought so too.
Yeah. Agree. Thank you.
Okay, so just with fleet cars, that's where they're stored at the office, where basically it's always stored there and they're kept under, I won't say guard, but under control of security, that type of thing. Generally, they're tool of trade cars, and they're generally not Surrey package cars. But what we would hope is that if you have valid logbooks for over 75% of the cars, then you're able to assume a percentage for all of those cars. So for example, if you've got, if those 75 logbooks, if you get 80% of your logbooks completed correctly, and those 80% indicate that there's 100% business use, then you'd be able to extrapolate that business use percentage over all of those fleet cars. I don't know whether you've done that over the last couple of years, Glenn, or not.
No, we stopped doing it last year.
Okay. So but if you can get over 75% of fleet cars with a logbook, you are able to use that concession to extrapolate it over all the cars.
This is just an example.
This is just an example of that, yeah. So it's basically a straightforward example here. Just going through, if you've got 50 cars, and of those 50 cars, you've been able to get at least logbooks for 40 of those cars, which exceeds 75%. In this situation here, the average logbook percentage was 85%, and therefore you can use 85% for all of those cars. And it's actually, you could use that for a 5-year period, as long as that's sort of indicative of the use. So it's quite a good concession for some employers, where you have trouble getting those last few logbooks. But obviously, to do logbooks, it is important they get filled out correctly, because we've probably been some organisations where logbooks haven't been completed that correctly. So even getting that 75% completion rate is quite difficult. We've just included a sample logbook there, and these are the elements that you really need to have. Generally, for each car, you need a logbook. You need to keep the odometers travelled, and the main thing is the purpose of the journey. Yeah, obviously private travel, you don't need to include any details on that. Whether it's a business trip, you do need to include reasonable details as to what is the purpose of the trip, with sufficient details in there to identify that it is actually business in nature in the travel. And finally, there is a reduction in the statutory formula method in the cost base of the car once you've held the car for after 4 years. So The example here, just to show, it's probably really the 5th year. So the reduction is applied in the FBT year following the 4th anniversary of the date the car was first owned or leased. So we'll just put an example in here. If you held it in 2012, then effectively the 4th anniversary would have been in 1st to the 5th, 2016. So then the first FBT you get the reduction is 31 March 2017. So it's really the 5th year you get that reduction that you've held the car. Another thing to be aware of, if people get their RFBAs, a lot of people, the RFBAs might not be that important, but they can be important if you're receiving certain government benefits, making spouse payments. You get an RFBA and the value of the car is included. However, in the situation where there's a shared car, there is no RFBA reported, so they're quite lenient on what is a shared car. It really just needs to be used by another person for one day, and that needs to be recorded. You need a record of that. In that situation, the RFBA will not be included on your payment summary.
And Stephen, this benefit is potentially subject to the minor benefit rule.
The car fringe benefit?
Yeah.
Yes, it would be. So potentially someone's shared your car for one day, and that's the only time they've used it. You get the advantage of it's not going to be subject to FBT on that day, and also it won't be on the RFBA of either people. Yep. Are there any other questions on cars?
No, Stephen.
Actually, I've just realized I'm going a bit slow here. But these have been the major benefits. So car parking benefits, we'll go through that reasonably quickly, but obviously in COVID, the car parking benefits should be a lot lower because people wouldn't have been taking their cars to and from work. The car has to be parked there for more than 4 hours between 7 a.m. and 7 p.m. And it has to be driven to and from work at least once during that day. And there must be a car park within a 1 kilometre radius for that to apply. So calculating the car fringe benefit, there's 2 real components. You've got to work out the valuation of the car park. So whether it's $6, $7, $8, you can do that using the commercial parking station method, which is just says, what is the daily rate? Get a market value, go and ask someone for a market valuation. We have found a lot of government departments use the market value method. The advantage of that is that they strip out the car parking levy to work out what is the car parking rate. So generally you will get a lower rate if you get a valuation. And then there's an average cost method that looks at the parking rate the first day and the last day of the year. We would say that the first day of the year, a lot of car parks were 0 or didn't have much in COVID, but the ATO doesn't really like that approach. So they said that's not a normal car parking rate. So, but yeah, most departments have gone to get valuations. I'm not sure, is DJPR getting valuations this year, Glenn?
Yes, we are.
Yeah, so have a chat to Glenn if you're uncertain about the valuation. So that's sort of standard. The big change this year will be the 3 methods to calculate the number of car parking spaces that are available, whether you use a 12-week register, the statutory formula method, or the actual method. In the past, most people just use the statutory formula method, but that allowed you to have 224 days of car park use, which if you're in Victoria, which you all are, will not be the case. So therefore, the actual method is going to be a lot more important. So going forward for this year, you would hope that there's got to be some records that people have kept as to when they've used their car parks. Look, if you know your office is shut down, or you've got some car parking, it might not be too hard, but it could be a bit more difficult, a bit more work this year because obviously the car parks weren't used anywhere near as much. Yeah, so I'm not going to go through the formula. It's pretty straightforward, but as I said before, it calculates based upon 228 days. So that's won't be that good for most people this year. I'm just making up some time here. I won't go through this. There were some COVID questions that we thought were worth asking. Is there parking considered available during lockdown for the purpose of statutory formula method? Basically, it's we wouldn't be thinking people would use statutory formula method during COVID because you can't get a reduction for it. You'll need to use the actual method. Would parking for essential workers when all commercial car parks were closed considered a car parking benefit? We still think they would be, but you have to have a look around what's available in the area. And that lowest parking rate, like during COVID, there wasn't many car parks open, but the ATO believes that you can't just go and use a zero rate using that 1 April 2020 date. You need to be using a more representative rate. So Rahul, I'm sorry I've gone a bit slower than I should have. So over to you, and you might get through living away from home allowance reasonably quickly.
No problem. Thanks, Stephen. Can everybody see my screen?
Yep.
Properly? Yeah, perfect. So we covered the LAFA first. Living away from home allowance fringe benefit arises if an employer pays an allowance to their employee to cover additional expenses and any disadvantages suffered due to them temporarily relocating to another place to perform their duties. So LAFA, to start with, is subject to FBT unless you satisfy some of the requirements for the concession. Now, before I go into those requirements for concession, things to consider while looking at LAFA benefit is whether it's traveling or LAFA. So in case of a LAFA, the employee is required to change his usual place of residence. For example, they relocate and lease a house for, say, 6 months. Whereas for traveling, the employee moves to a new location, but the lifestyle in the new location is transitory in nature. For example, he might just stay in a hotel as opposed to leasing a house for 6 months. Now, the two key requirements to get the concession under LAFA is that the employee has to maintain a home in Australia while they are living away from that home. So for example, somebody moves from Melbourne to Sydney for 6 months, he should be maintaining his home in Melbourne and the home in Sydney where he's currently living. And the concession is only available for a period of 12 months, for a maximum period of 12 months for any particular location. So if somebody has gone from Melbourne to Sydney in that example, the 12 months period in Sydney is over, he cannot go back to Sydney and get the LAFA concession again. He has to go to another place for the concession to apply.
So I think I just want to add here, Rahul, that for our department, LAFA is mostly comes in play for our VGTIs. So the locally engaged staff, the commissioners that are overseas and living. So that's where it's mostly applicable.
Yeah, thanks, Rupali. So the taxable value of a LAFA benefit is the cash that the employer has incurred, the expenditure that the employer has incurred, less the concessions available. So for example, if the cash incurred is, say, $10,000 for accommodation and the employee qualifies for the concession, the entire reduction of entire amount of LAFA benefit subject to FBT is reduced, provided the expenditure is substantiated and a declaration has been obtained. So we've got some questions here that we've received during the COVID environment for people going on LAFA and what happens to them if they return back to their home location early. Now, the first question that we got was, what happens if a commissioner has gone from Melbourne to, say, India and comes back early because of the COVID situation there? So in that instance, if he's come back early, say, I've got an example, the next slide, I think, yeah. So if he comes back within 9 months into a 2-year assignment, the concession is available for the first 9 months, and he's still got 3 months of concessions left. So he can go back to India and avail those 3 months of concession. The employer would have to pay for some relocation flights and expenses. They would be considered otherwise deductible because their travel back into Melbourne would be considered work-related. And if they are traveling back to Melbourne and they are required to stay in quarantine or sponsor for their food for themselves or their family while they are in quarantine or while they are waiting to travel back, all these benefits would fall within the definition of emergency accommodation costs. As such, they'll be not subject to FBT. Another one we've been asked is employees temporarily stuck overseas and they've exceeded the 12-month period. So up to the 12-month period, you've got the LAFA concessions available. Say, for example, somebody has to stay back for 14 months. So the extra 2-month period would likely be falling under the definition of emergency accommodation, and as such, not subject to FBT. Last example we had was benefits provided to a fly-in, fly-out worker who cannot travel back home due to travel restrictions. Again, any benefits provided to this individual is likely to fall under the definition of emergency accommodation. Next is loan fringe benefits. So loan fringe benefit arises from a loan to an employee or an associate on which no interest or interest lower than the benchmark interest rate has been charged. Now the benchmark interest rate for this year is 4.8%. So if you're charging less than 4.8%, you would have an FBT benefit for loans. Now, as a government department, you guys don't have loan fringe benefits, so this is not of that much relevance. So I'll keep moving off this one quickly. And with a loan comes a debt waiver fringe benefits. If a loan hasn't been repaid and it's been forgiven, it would result in a debt waiver fringe benefit. And the taxable value would be amount that has been forgiven. In-house benefits. In-house benefits are benefits that the employer normally deals with on a day-to-day basis as part of their business activity. Example being Art Center providing tickets to their staff, or we had a question from one of the participants where the question was asked whether tickets provided by Tennis Australia to their employees. So they would be considered an in-house benefit. Now, how do you calculate the taxable value of an in-house benefit? It depends on whether it's salary sacrificed or not. So if it's salary sacrificed, the notional value of the benefit, which is the value at which it was sold to the public. And if it's not salary sacrifice, you get a 25% reduction in the notional value of the benefit. So 75% of the notional value of the benefit will be considered a taxable value of the benefit, less any employee contributions. You also get a $1,000 reduction per employee for in-house benefits. Now, point to remember here is this $1,000 reduction per employee is available for each employee only. So if an employee gets 2 tickets and the value of those 2 tickets exceed $1,000, you can reduce it up to $1,000 only. And it does not apply to salary sacrifice benefits. In addition, one tip to remember is the minor and infrequent benefit exemption does not apply to in-house benefits. Some other benefits that might be relevant this year is relocation. So if an employee has to relocate from their usual place of residence to perform their employment duties, the benefit would be taxed in the FBT world in a concessional fashion. Documentary evidence will need to be obtained by the employer for these expenses. Common examples of relocation benefits are removal of and storage of household effects, relocation, transport and accommodation costs, connection or reconnection of utilities, leasing of household goods, and temporary accommodation at a new location. Now, this temporary accommodation at a new location is dependent on whether you owned your home or leased your home. And depending on that, you get either 4, 6, or 12 months. As these benefits are concessionally taxed, there's a lot of motivation on the employee's part to salary sacrifice these benefits and obtain a tax savings out of these. Study assistance is also a very common type of benefit. So study assistance is generally subject to FBT unless it is otherwise deductible. So as a starting point, you would treat it as subject to FBT and then see whether the otherwise deductible rule applies. a valid declaration has to be obtained in order for this benefit to be otherwise deductible. Now, a tip to remember here is the course fee or the study assistance is subject to the otherwise deductible rule. Sometimes employees seek reimbursement of their help debt. Now, help debt is repayment of a loan, not repayment of a course fee. Repayment of a course fee is subject to otherwise deductible. Repayment of a help debt is not subject to otherwise deductible. So it is important to see the paperwork before processing the reimbursement on your system.
So Rahul, with this study assistance, what happens is we, as part of learning and development for employees, they would do certain studies. They could be doing like a graduate or postgraduate, but as part of their learning and development. So then is that subject to FBT or is it otherwise deductible and not subject to FBT?
Yeah, good question, Rupali. The issue there to consider is whether the employee would have got a tax deduction for that course fee had he paid for it himself. Now we go back to the basic principles, whether something is incurred in deriving assessable income or whether it is incurred in enabling the employee to become capable so that he can start deriving assessable income. So I'll give you a very basic example. We get, or actually the department reimburses employees for their CPD hours, training courses and things like that. They're already educated in that field and they're just doing a refresher course to bring themselves up to speed with the current rules. In that case, they would get an otherwise deductible deduction and it's not subject to FBT. Whereas a newly graduate who's joined the department gets his course fee for his graduate diploma reimbursed by the employer. In that instance, as the employee is still studying, and this study will help him to be in a position where he can start deriving assessable income, it would not be otherwise deductible. So the answer depends on the course undertaken and the employee situation.
Okay, thank you.
One thing to always remember with employee contributions and FBT is GST. So employee contributions reduce the taxable value of the benefit, but they have got a GST aspect to it. So employee contributions have two parts. One part goes towards the reduction of your FBT value, and the other part needs to be reported in your BAS. So 1/11 of any employee contribution should be reported in your BAS and paid to the tax office. And the remaining amount, 10/11, should be reported as assessable income in your accounts. Important to remember, employee contributions, for them to reduce the taxable value of a benefit, they should be after tax contributions, not before tax. Reportable fringe benefit amounts. So fringe benefits, other than some excluded benefits such as car parking, shared cars, are reported on the employee's payment summary when they exceed $2,000. The amount reported on the payment summary is grossed up using the type 2 rate, and the benefit, whether or not the benefit is GST creditable or not. So if it's type 1, type 2, doesn't matter, it gets grossed up using the type 2 rate. Now, RFBA can be a sensitive issue for some employees because it does get reported or does get counted for a lot of government benefits that the employees get. Sorry, I jumped a slide. I'll go back to the other one after this one. So RFBA is taken into account in calculating the Medicare levy surcharge, income tested government benefits, help repayments, child support payments, and family allowances. So that's why it gets a very sensitive issue when it gets reported in an employee's payment summary. These are the benefits that are considered excluded benefits, which means they don't make their way into a reportable fringe benefit amount. So non-salary sacrificed meal entertainment, car parking benefits, pooled or shared cars, and certain remote area fringe benefits. The last slide is on administration. So always bear in mind that declarations are required to reduce the taxable value of certain benefits. They should be obtained prior to the lodgement of the FBT return. This year, because of COVID, there is a general acceptance of electronic declarations, but do check your internal policies and procedures to make sure they are compliant and they cater for electronic declarations. The case should be kept on file for at least 5 years. And while preparing the FBT return, it's always a good practice to review the vehicle and travel policies to check if they are current with the ATO's views and the legislation. Any questions on the benefits that we've covered so far? No. Take silences now.
No, Rahul.
Perfect. Thanks, Glenn. Now I go through some recent developments. The rates and thresholds for the current FBT year haven't changed since last year. Every year, the commissioner issues rates and thresholds that apply for the relevant FBT year. For example, the cents per kilometer rate, which was generously increased by 1 cent. I've got the list here. I wouldn't go through all of them, but the references are here in this slide in case you need them.
Rahul, I had a question by one of the employees that they have a motorcycle and they use their motorcycle for business travel.
Correct.
And would they get any kilometers in return when they are using their motorcycle? So I understand that we've got this car cent per kilometer, which is I think 69 cents or something.
Yeah.
But what about motorcycles?
I think in that tax ruling, TD 2033, there is a right for motorcycles as well.
Okay.
So there is a right for motorcycles, there's a right for cars under 2,500 cc, and there's a right for cars over 2,500 cc.
Okay, so there is a specific rate for motorcycles. We just need to update our policies to reflect that.
Correct.
Yeah.
Correct. And just to remind that motorcycles are a residual fringe benefit if they are being provided by the employer, which is not in this instance though.
No, not in this instance.
Yeah. Some key dates on the 2021 lodgement program. So FBT returns and the payment are due on 21st of May, unless you've got an extension by way of getting onto an agent's list, in which case your payment date is extended by 7 days and your lodgement due date is extended until 25th of June, 2021. Now for this, you have to be on the tax agent's list by 21st of May. So if you are expecting an extension, make sure you check with your tax agent whether you are on their list or not. There have been some ATO rulings that have been issued this year. Now, this year has been a bit different from other years where we adopted to the new remote working style, and travel was the last thing on anybody's list with the ATO. Like in February this year, ATO finalized its tax ruling on travel expenses. One of the key tests in the ruling keeps referring to the John Holland case, which is whether or not the employee is under the direction and control of the employer while traveling. In addition, ATO also issued draft tax ruling TR 2021 D1 on when an employee can deduct food, accommodation, and drink expenses. It also sets out factors to consider when determining whether an employee is living at a location or relocating. To complement these draft rulings, a practical compliance guide was also issued, which outlines ATO's approach in deciding whether an employee is traveling on work or living at a location. The concept of 21 days, which was previously disregarded, has now been reintroduced. The guidelines are, however, pretty light on dual purpose travel, which is not really helpful.
So what's the ruling when someone is stuck? So like they're stuck in a place because of COVID. Are they considered traveling or are they considered living?
Look, it depends on why they went there in the first place. So, I mean, if they went there in a LAFA arrangement while they are stuck, it would still consider as LAFA, but any benefits you provide would be considered emergency accommodation and treated concessionally. So it starts to look at the basis on which you went there in the first place. However,
Okay.
these are draft tax rulings, so they are open for discussions. That they are not law yet.
Okay, so if we went for a business travel and then we got stuck for 2-3 more days because of flights not running, then that would not be
FBT-able, correct. It
So
would
that's
be
not
either
giving, there is still traveling. That's still
Correct.
considered as traveling. Okay, yeah.
correct. With the release of these 3 guidances, the old draft tax ruling has now been withdrawn. So these rulings are quite timely given the work patterns developed in the last 12 months and the uncertainty around business travel. So it's a good time to look at your travel policies and see if they are compliant with the draft rulings, with the views expressed by the ATO and the draft rulings. Some of the other COVID concessions, we got it on the slide, reasonably self-explanatory. If you have any questions, feel free to email either Stephen, myself, or Rob. But in the interest of time, we'll keep moving. Over to Rob for some GST issues.
Thanks, Rahul. All right, I'll try and now give you a summary of GST in about 5 or 10 minutes. So can everybody see my screen?
Yes, Rob.
So Rapali, let me know when you want to finish this. I'll try and cover.
We've booked it till 12:30. We booked the seminar till 12:30. So I think we are not in such a rush. So you can take your time.
Right. So the purpose of this is to give a bit of a rundown on the general rules of GST, some of the exceptions to the general rules, and in particular GST and government issues in relation to appropriations and grants, and also some recent developments in GST. As Stephen said, there hasn't been a lot of recent developments in GST. There hasn't been much in the way of COVID-specific alterations to GST. It's pretty much continued on as always. So general rules, we'll go through classification of supplies, time of supply rules, place of supply rules, and value of supplies. For imports, we'll just note here at this stage that for importation of goods, GST is paid at the place of import rather than to the overseas supplier. Importers that are registered can defer the GST, quote an ABN at the time of import. Customs then provides the ATO with the information on the GST that's due, which is then included in the next business activity statement. And in the case of a business that's fully taxable and fully creditable, they just cover set it off by way of an input tax credit, so there's no actual cash flow on the import if the business is registered and fully creditable. Right, GST. So first of all, GST is a classic value-added tax. It's a tax that's calculated on each step of the production process. It's historically based on the production of goods, but it's also applied to services as well. So the value added at each step of the process is subject to GST, and then a credit is passed on to the next step in the process until it reaches the final consumer. And the intention is that it's a point that the ultimate cost of the GST is borne by the end consumer, which will be comprised of all the components in the line up until the point of final consumption. So there's 3 types of transactions in Australia. Taxable, which is where businesses account for GST on sales and recover full GST on costs. So that's how you calculate the value add for that particular step in the process. There's GST free, where businesses don't account for any GST on outputs, but they can fully recover GST on costs. So that makes it effectively GST free to the end consumer. And there's what they call input tax, where businesses account for GST on sales. Sorry, that's wrong. Businesses don't account for GST on outputs, but cannot recover the GST on costs. In addition, some things are outside the scope of GST, so suppliers that are not in the course of a business or in the course of an enterprise, or supply of goods or services occurring outside of the indirect tax zone as per the legislation, hereinafter referred to as Australia.
Rob, can I ask a quick question at this stage?
Yep, sure.
In lodging our BASs, is there any risk of a misclassification between GST free and out of scope? For instance, overseas transactions, we've seen cases where some have been classified as GST free and some out of scope. So if we get this wrong, is there any risk given that there's no GST in both cases?
Well, the short answer is no, it shouldn't make much difference on the basis that there's no GST on the output. However, depending upon how you're claiming input tax credits, there might be some difference. So if it's GST free, you can claim input tax credits on the inputs. If it's outside scope, it then becomes, it's a bit like a black hole expenditure question as to whether you can claim input tax credits. So, or to put it another way, have you incurred the inputs in the course of an enterprise if the output is out of scope? So, sorry, does that make sense?
So in both cases, if there's no input tax credit, then it doesn't matter. That's the bottom line, isn't it?
Yeah, if there's no input tax credits,
Yeah,
it doesn't.
yeah, okay.
It might matter if you're claiming input tax credits.
Yeah, thank
you. GST-free suppliers, so there's a number of things, basic food, so fruit and vegetables, things like that, not processed foods, healthcare supplies, and provision of healthcare itself, GST-free, education and childcare, international transport of goods and passengers. So that's the international leg of those things. There's a domestic component. The domestic component is not is not GST free. But if it's all wrapped up in international transport, then the domestic component of that single supply is GST free. Exports of goods and services. So we will get to that. Water and sewerage are also GST free, as are religious and charitable activities. Input tax, there's two types of supplies that are typically input taxed. Financial supplies, so loans, bank accounts, things like that. But it's a broader category, so there's a number of things fall within financial supplies. Also input taxed are residential accommodation, rent and sales of non-new houses and apartments. So that's just residential accommodation. When you get to commercial residential accommodation, hotels, motels, things like that, it gets a bit more complicated. But pure residential accommodation, homes, and so rent of homes, provision of non-new homes are input taxed. So no GST on the sale, but no input tax credits on the costs incurred. Time of supply rules. Time of supply determines when the GST is attributable. Now, there's two types of attribution. You can do it on a cash accounting basis. So that's subject to falling within a small business test. Otherwise, it's subject to accruals method, which is basically when invoices are issued and received. The main exception is receipt of deposits. So a reasonable deposit to secure an obligation, that's typically 10%, so sale of land or anything else where you pay a 10% deposit, which is held to secure secure the obligations under the contract. That's not subject to GST until the supply is made or until the actual invoice for the final settlement is provided. However, where the deposit is forfeited, then you're liable to account for GST, regardless of whether there's an underlying supply made, and that will be attributable to the point at which it's forfeited. Place of supply. Now, place of supply is particularly relevant to GST-free and exports. So it's important to know where the place of supply is. So typically, goods and services supplied within Australia are within the scope of GST. Exports from Australia are generally not. Now, that depends upon the place of actual supply. Now, GST-free covers supply of goods and services, or supply of goods, sorry, where the goods are to be exported within 60 days. But you also have to look at the place of supply. So if I supply somebody overseas and the goods are to be delivered DDP to overseas, then I've made a supply to somebody overseas outside of Australia. If it's delivery within Australia, but it's to be exported within 60 days, then it's GST free. So again, you get the same result. One's GST free, one's just outside scope, but you have different methods of accounting for it. Supplies relating to real property in Australia are always within the GST net. Sometimes there's grey areas about what relates to real property in Australia. Obviously, if you've got people coming in and doing maintenance or cleaning, then that relates to property in Australia. If you've got a property manager, then that will also relate to real property in Australia. If you've got an accountant that's dealing with a portfolio of assets in Australia, then that might not relate directly to real property in Australia. So there's grey areas there. Work on goods located in Australia is provision of a service within Australia, although if it's goods to be re-exported out of Australia, then it might be GST free. Supply of low value imports to Australia. So these are the Amazon type imports. The government has moved to impose GST on imports into Australia via Amazon and things like that, where they're low value imports less than $1,000. And also the so-called Netflix tax, where Australian consumers, not Australian businesses where it's fully creditable, but Australian consumers acquire services directly from offshore, such as Netflix, but it also covers a much broader range of services. So Australian consumers sourcing services directly from offshore might be subject to the Netflix tax. Exports of services. Services supplied for use outside of Australia or to persons offshore are GST free. But the rules are quite complex as to where the services are provided and whether they're GST free. So if they're supplied to a non-resident business, then they're generally taken to be GST free. if they're a supply to a non-resident other than a business, well, in fact, a supply to any non-resident who is not in Australia at the time of supply, again, it's generally GST free. Suppliers that are used and enjoyed outside Australia by somebody who is not here. So that could be an Australian resident that acquires services outside Australia. So the typical example of that is somebody that's overseas and using credit card services. That's taken to be a supply outside of Australia, whilst the Australian residency is overseas. Also, supply of rights for use outside of Australia is a GST-free export. All right, the value of the supply. Value of the supply is determines how much GST is payable. Now, value is described as the GST exclusive amount. So the GST is equal to 10% of the value of the supply. The price of the supply is the GST inclusive amount. So typically you work backwards using 1/11 of the price of the supply to get the GST amount. Consideration is defined as the GST inclusive amount paid for a taxable supply. So that's by reference to price. Now, when you get into contracts and commercial dealings, it can get a bit confusing because often contracts state that words have meanings as defined in the GST legislation. Then they'll typically use consideration in a different manner. Typically, they'll refer to consideration payable under the agreement as exclusive of GST. They might also use GST in other might use consideration in non-GST contexts where it clearly means the GST inclusive amount. Now that can have implications if contracts are drafted so that the GST clauses don't work because they're obscure or they're incapable of courts defining any definite meaning. Then the whole thing can just fail. It happened in a case of City Rose, where the court just couldn't define what the GST clauses meant. So it had a rather adverse outcome in that particular case. You do need to be very careful about the definitions used in commercial contracts. Government departments. So government entities are specifically included as entities for GST, even though they don't carry on an enterprise. That means departments can voluntarily register. If they register, that means that they'll be able to recover GST on their costs. And correspondingly, they'll have to pay GST on outputs. But depending on the circumstances, there might be a lot of GST on outputs by a government department unless they're making profits on things. Where registered, government departments are each treated as separate GST entities. So government-related entities include government departments, but can also include divisions within government departments, which operate as separate business units effectively, as well as statutory agencies. And it includes Commonwealth and state. So state departments are government-related entities as well. Supplies between government departments and government-related entities are subject to the normal GST rules. However, GST doesn't apply to payments to government entities for taxes, fees and charges, for things like recording, copying, modifying, allowing access to, or otherwise searching or gaining access to information.
So, Rob, the most common ones that we have with different departments would be when we are recouping costs, and when we've got an employee from one department working in another department, and then we have to invoice the department to get the costs of that employee. Now, in instances like that, do we apply GST or we don't apply GST?
Well, I think if you're supplying the services of an employee, I don't think it will come under the appropriations.
No, this is not appropriation, no.
So I suspect you will have to account for GST because you're effectively providing a service, and unless it's under the appropriations provision, would be subject to GST. So that's if it's between one government-related entity and another. If it's within the same government entity and not within different government entities, then just accounting between divisions within a department wouldn't be subject to GST.
Okay, so then we have to apply GST whenever there is an secondment. It's not a secondment when we basically have got our staff working for, say, for example, Department of Health. And then we apply GST to the invoice. Okay, thank you.
Yeah, I think that's right. I haven't looked at it specifically, but I can't see why it wouldn't be subject to GST. You're supplying a service to the other department. That's assuming both entities have actually registered for GST.
Yes, yes, all departments are registered for GST.
So the other two exceptions for government are appropriations and government grants. Now they can have a similar spheres, but they're two separate issues. So appropriations first of all, taxable supply occurs where there's a supply of something and there's consideration for the supply. Now, they're two key concepts. Typically, a supply has to be made in the course of further insolvent enterprise. That doesn't apply if the supply is by a government department or a government-related entity. And the supply has to occur in Australia. So you still need to work through those tests, whether there's something being supplied, whether there's consideration for the supply, and whether there's supply made in Australia. As I said, the third test is not so relevant if the supply is made by a government-related entity. Now, in the case of government-related entities, appropriations are not subject to GST. So that includes where there's consideration for a supply where it is paid by one government-related entity to another government-related entity, and it is for making a supply, but it's covered by an appropriation under an Australian law, and it's calculated on the basis that it doesn't exceed the actual costs in making the supply. So that's the non-commercial test. Now, there's been a history of the way appropriations have been treated under the GST law. There was an old provision which caused a lot of litigation, which resulted in BT Line's case. And there was also a ruling, which I think was 2011, number 11, about what amounts to an appropriation. Now, all of that's been replaced with new provisions, and that ruling has been withdrawn, but it might be worth referring back to the ruling in some circumstances to work out whether it is an appropriation, but you need to be careful because, as I said, that ruling is on the old legislation before it was revised. If all of those conditions are met, then there's no taxable supply. So what is an appropriation? Payments between departments and agencies that are part of the legal entity, being the Crown in that jurisdiction, which form part of payments out of the consolidated revenue. So typically appropriation bills are part of the budget. They will appropriate money to specific departments for specific purposes, and that will amount to the appropriation. Now, there's levels, different levels of appropriation. So there's appropriation at the departmental level, but then there's appropriations to different functions within the department or different projects within the department. So payments between government departments and government-related entities under the appropriation are generally covered by that provision. However, once a payment's made to a separate legal entity or to a different entity, or any on payment to a separate GST entity, then it's less likely to be covered by an appropriation. So getting back to Rapali, your example about the staff member on secondment, the appropriation bill will cover your staff costs. But then if you're supplying them to another department, then that payment is not part of the appropriation. As the slide says, this gets overly complex, and if there's any doubt, it's best to seek ATO advice on it. As I said, the old provisions caused no amount of consternation, and the new ones aren't necessarily that much better.
Rob, does this provision apply to entities between different governments, like between Victorian and say another state, an entity from another state?
In theory, it could, because it applies to anything between government-related entities, but it'd be unusual for a Commonwealth appropriation bill to appropriate money towards a payment to a state. I can't conceive of any circumstances where it might arise. It could in theory.
Recently, we had a case. We provided some funding to another state government entity for some work that is related to quarantine Pacific workers, I was told. So would that apply to that situation? Because government entities is within any government in Australia, isn't it?
Yeah, that's right. Yes, as I said, in theory, yes, because they're both government-related entities. But
Yeah.
would it be covered by an appropriation? I'm not sure that it would.
That funding would have been, I would have thought.
Yeah, there's an example just that's come through the chat. Just to read this one out, it says like there's overseas officers of DJPR have paid on behalf of Australian departments, presumably that's the federal government, for goods services provided overseas, and asked DJPR to raise an invoice to recoup the expenses. And they've said, should the recoupment charge GST or not? So, so it's a recoupment of expenditure, but it depends what, I suppose, is there a margin or not on it, as to whether or not they'll charge GST. So I'm not sure.
There's no admin costs. There's no admin costs in those. It's simply the recoupment. So what would happen is that the minister and few of ministers, colleagues, and from other departments have all gone, say, for example, to China. And in China, we've got our VGTI office. So whatever the cost was that incurred in China, we would have to recoup that from the other departments. So that's the instance. So we don't charge admin cost. It's more the cost that had incurred.
Yeah. Yeah. As I said, government-related entities cover both Crown in right of the Commonwealth and Crown in right of the state, plus their agencies. So in theory, they're all government-related entities. So if it falls within the appropriation requirements, then conceivably, yes, that still applies. As I said, it's complex, and often it depends upon the terms of the appropriation and the particular circumstances. So it's always going to be a question of how it applies on the facts. But in theory, yes, it could be an appropriation.
So I think the general rule is we always charge GST because the risk is with us getting it wrong, not with the other side of the party, unless they can demonstrate to us why it shouldn't be the case. So obviously, if you get into an argument, then over it, you go, okay, let's go and consider the issue. It's sort of charge GST first, ask questions later would be the approach. If they're saying it shouldn't be, I think there's probably a reasonable argument that if it's a recoupment of expenditure, that there is no margin on it at all, and potentially it's an appropriation. But our general approach is to charge it first unless they ask otherwise.
So I think my general rule is, if in doubt, apply GST, because there's no harm in applying it. But if you do not apply when you should have applied, then ATO can knock on the door. So that's my general rule. Whenever in doubt, just apply GST.
Yeah.
But in the grant space, there's some of the recipients are potentially not registered for GST. That's where the complication is.
Yeah.
Yes, that's complex. And I think in grant space, it gets very complex for us to assess where a supply is being made or not.
But Stephen, you raised a point just then. The onus is on the recipient to get it right, isn't it?
Whoever's issuing the invoice,
Yeah,
is the one that the onus is on. Yeah.
but very often we, the payer, get to ask the question, what is the correct GST treatment?
Yeah. So if we're paying it, and if in doubt, well, generally you can claim it back in your next BAS anyway. So unless it's something worth a couple of millions of dollars, it's generally not a big issue, and you just pay it and move on. I would have thought would be the general approach.
Yeah, I think in most cases that's correct. Like I said, the only exception is when the recipient is not registered for GST.
Oh yeah, sorry, it's not registered.
Yeah.
So I think with our grants, what happens is, Stephen, we'll have 4 or 5 that are registered for GST, 4 or 5 that are not. So that's why I think the businesses are very keen on understanding when is GST applied and when is GST not applicable. So that's where the concern is.
Maybe Rob, go on to grants.
Yeah, so yes, you're right, Rapali. Grants is a complex area, and it's always a grey area. So the basic premise is a taxable supply is where there is consideration for a supply of something. Now, there is a ruling on when things might just be a grant. A grant is where a payment is made and there's nothing provided in consideration for the grant. So there's no supply made in return. Now, at its very basic level, if I grant money to somebody to carry out their function, and they don't undertake to do anything in return for the benefit of myself, then that's just a grant of money. If a government department makes a grant to somebody and just asks them to account for the expenditure of the money, typically that wouldn't be a supply made for consideration, the supply of the information just to say how the money was expended. But conversely, if I pay a grant to somebody to go and do some research and provide information back, which is of any value to me, then that will be a taxable supply, not a grant. So it really looks at whether I get anything in return for the money other than just compliance with the terms of the grant. If there's any benefit in return, then it's likely to be taxable. And as I said, or as you've said, Rapali, when in doubt, just charge GST.
So Rob, in that sense, that when you are saying that, is there any benefit to to our department. Now, if there is a benefit to the community, that's an external benefit. That will not be considered as a benefit to the department?
No, community benefit generally no. And there might be some benefit in the sense that the department achieves its objectives. That wouldn't be consideration. But if you're getting something back, so as I said, if you give a grant to somebody and you just ask them to account for how they've expended the money, that wouldn't be subject to GST. If you give a grant to somebody to provide a particular function in the community, which is part of the department's objectives, that would be subject to GST.
Okay, thanks.
So if you're achieving the department objective by effectively engaging an organisation to carry out a function, that would probably be subject to GST. But if you're just benefiting from the entity providing a community benefit overall, possibly not.
I think an example, like if you give a specific grant to a football club and they have to build their club rooms, that they could potentially be subject to GST. But if you just give that money to a football club, they could do with that money whatever they want. That's just a general grant, then that wouldn't be subject to GST.
Yeah.
But you're unlikely to do that second one.
And just to follow on from that.
No, we'll usually, when we give them money, it'll be either that they have to build something or they have to improve certain things. So for example, we might give the sports entities some money to make sure that every sporting arena has a female toilet, or playgrounds have female toilets, that sort of thing. So if we're giving them to build something, that are, yeah.
They should be charging you GST, but it's their risk, not the government's risk.
Yeah.
Okay.
Yeah.
But
So
if they usually look up to us for advice. That's the problem. That's how it's been done in the past. And so in this instance, you think GST is applicable?
Yes.
Yes.
Okay.
If they're undertaking an obligation in return for the payment, then yes. Yes.
Okay, thank you.
So I'll try and wrap up fairly quickly. There are a whole range of fees and taxes charged by government departments, which are all set out in a very comprehensive schedule that are exempt from GST. So things like collection of curbside waste, etc. Everything through to national park entry fees. Other issues, look, as I said, there haven't been any real issues in GST. There's nothing COVID specific. One thing to watch out for with GST though is if you're using the accruals method, GST is payable when you issue an invoice. If you defer or extend time for payment or do something like that, that doesn't necessarily mean that you get any relief from the obligation to account for GST. It's only in specific circumstances where you either write off debts or you waive them by some sort of formal arrangement. Simply extending time doesn't mean that you can recover any GST that you've paid. And apart from that, there's probably a whole lot of other issues in GST, but that's probably all we can cover in the time. So I'll hand back to Stephen at the moment, I think, and we can deal with any questions.
Yeah, I just saw there was a couple of alternative views that have come up in respect of the Q&A that says if we don't own the asset, then we haven't been applying GST in the past. So look, we might need to, in this context of sporting stadiums, that type of thing. So it's probably something, look, I don't think we've advised the department on that one before. I'm not sure whether you've got that. We probably should circulate and get a clarified view on that one after the session, Rupali and Glenn, just to be clear on that one. Maybe circulate that around. I do know there's a few people raise that issue with it.
Yep, happy to take it offline and then get back to the participants.
Yeah. So, I think we're right on time. So I might hand it back to Rupali to wrap up, but thanks a lot for the opportunity to present today.
Thank you. Thanks everyone for attending the session. And I hope the session has provided some insight to everyone in relation to FBT and GST. I know that these are complex issues, especially the GST in relation to grants is quite complex for us, and FBT in itself is a very complex thing. So thanks everyone for attending this session. If you have any questions and that you haven't been able to raise in this session, please feel free to email me. And where possible, I might reach out to Stephen, Rob, and Rahul for answers. I will also now like to take the opportunity to thank Stephen, Rahul, and Rob for the presentation. This has definitely been quite insightful for us. So with further ado, if no one has anything, I would like to call this session close.
Thank you.
So thanks, Stephen and the team once again. Bye.
Thank you for the opportunity. See ya.